Welcome to the Transparent FX Academy. I'm Nick and I'm a top author on trading with over 190k reputation points. In today's tutorial, I will show you not only how to avoid fake breakouts, but also how to use them to your advantage to find high probability setups. So without further ado, let's drop straight onto the charts. And also keep in mind that to gain the most out of this video, I really suggest to watch it till the end, because that is the moment in which everything will start to make a lot of sense when we put everything together. So bear with me, because this will be a very interesting tutorial and video. Let's get to it. Okay, so before we move to the actual charts and see how we can use fake breakouts to our advantages, let's move step by step. Let's first start by the definitions and from the analytical concepts when it comes to fake breakouts. Starting from the definition of a fake breakout. Now, fake breakouts are when you have a level of support or resistance, doesn't really matter, that has been tested multiple times. So let's take, for example, a fake breakout of a support level. So in order to be strong support, you need to have multiple tests of that support level. Or if it is a weaker support zone, it can be even only one test of support. So let's say, for example, a previous low. That defines the support area. Now, usually what most traders will be doing when they see strong support or support in general, they will try to trade that support, that bounce away from support. These are commonly referred to as support and resistance traders. So traders that identify support and resistance areas on the market, and they're looking to trade the bounces away from these areas. However, if you are an institution and you're looking to trade as well away from that support, for example, is not as easy for you as if you are a retail trader. Because if you are a retail trader, you can just click the button and buy. However, if you're an institution that you have a lot of money to manage, then you have a problem, because there isn't enough liquidity in the market sometimes to actually just place your order. That is why, for example, when we look at the COT data, so how the biggest speculators and institutions in the market are moving their orders, we can see that it takes for them sometimes even months to place all their trade. So their huge lot size, because they have to slowly put their orders in, because for every buyer in the market, there needs to be a seller. For every seller in the market, there needs to be a buyer. And for them, simply there isn't enough money at any specific time to just press the button and buy everything that they want to buy. So what they have to do is create those sellers. If they want to buy, for example, the bounce away from a support area, they need to create the sellers, because there isn't enough liquidity for them to just place the order. So what they do is create fake breakouts, or in other words, stop hunts, okay? Fake breakouts are simply stop hunts, because most of those retail traders that we were speaking about before, that are looking to trade the bounce away from the support, they have their stop losses below the support zone. And a stop loss order, if you're looking to buy, is simply a selling order, because it is an execution to sell anything that you bought in order for you not to lose more than what you had decided that you would be risking. So if they go and trigger those stop losses, if they manage to bring the price low enough to actually trigger those stop losses, those are all selling orders that get flushed into the market, and they can use those selling orders to actually buy. So as you can easily understand now, they created selling pressure so that they could buy, because as we said before, for every seller, there needs to be a buyer. So those are why fake breakouts are created in the first place. So what they will do, they will create a close below the support. The candle will close below it, because that will attract even more sellers that will start selling, because they say, okay, not only I have been stopped out, but also this support is now broken, plus other people that were just waiting for that support to be broken to start shorting. All that selling pressure enters the market, and that is exactly what they need in order to buy. So they buy, and after that, you get a huge green candle. If you have been in the market long enough, you probably notice that this happens quite often, okay? Maybe you also got trapped in some of these situations where you shorted and the next candle just skyrocketed to the upside, breaking back above of the support, or you were looking to buy at support, you had your stop loss just below it, the market went to the downside, triggered your stop loss, and then immediately rejected to the upside. If you have been long enough in the market, you probably already experienced something like that firsthand. Now, how can we take advantage of situations like this? The first thing that we need to know is that this happens most of the times, okay? So most of the times before the market actually creates the big move, you will have a fake breakout, because until you get a fake breakout, institutions have not entered yet, or at least they haven't entered yet with their full position size. So the first thing that probably you already are thinking is, okay, so why not just wait for that fake breakout? And worst case scenario, if that fake breakout doesn't happen, which in most of the times it will happen, if it doesn't happen, I just move to the next setup, because there will be another time in which the fake breakout actually happens. That is a very good observation. In fact, that is exactly the first step in order to avoid to get caught in fake breakouts, is to wait for the fake breakout. Be patient and wait for institutions to do their manipulation, and then enter afterwards together with them after you have the confirmation that the manipulation has already happened. And I will now show you on a real chart how you can do that. The second thing is that it's very important to wait for the next candle to close back above the support. That is the confirmation that the fake breakout has actually happened. Because if you have a close below the support and then the next candle just goes up but doesn't close back above the support, that could still be a break, retest, and continuation to the downside. So you don't know that that is an actual fake breakout. Okay, very, very, very important. Now, if we move to an actual chart to start to see how you could incorporate that into a fake breakout trading strategy itself, let's take, for example, here USD CHF, because a fake breakout just happened here. Now, here in the weekly time frame, it was very clear that we were at weekly support, okay? Which brings me to a very important point. If you have a support level on the weekly time frame that is looking to be confirmed and respected, most likely on the lower time frame, which is the daily, you will have a fake breakout. Same thing on the daily. If on the daily time frame you have a support level that the market wants to respect, there is a good chance that on the 4-hour time frame you will have a fake breakout. Because if you look at it on the weekly time frame, it is clear that this support was never broken, right? This is all wicks. However, these same wicks here, if we go down on the daily time frame, we can clearly notice how actually have some bodies. And here we actually had a candle which closed below the support, and then the next candles closed back above the support, confirming it as a fake breakout. Then we had the retest of the support and the massive move to the upside, showing that after this candle here, which stopped out all the traders that had their stop losses below these levels, and they closed below the zone, which brought even more traders into the market, which started selling. The next candle tested its zone but didn't manage to close above. This one closed back above. This is the candle that confirmed this as a fake breakout, showing that institutions actually had a chance to enter inside of this zone. And in fact, the next candle retested its support and started the rejection to the upside. Okay. Same thing, if you have a support level, there is a good chance that on the 4-hour time frame, that is where you will have the fake breakout. If you have a 4-hour support, there's a good chance that on the 1 hour you will have a fake breakout. If you have a 1-hour support, there's a good chance that on the 50 minutes you will have a fake breakout. Okay. Now, in a situation like this, it's clear that you had immediately a massive rejection to the upside. Now, it's very, very important also to point out where is the best area for a potential trade in the case of a fake breakout. Most of the times, you will have the retest of the fake breakout after the close back above. So the most common movement of the market is this. The market creates the support, you have a close below, close back above, then the market goes for the retest of the previous support, which is now against support, and that is where you get the massive move to the upside, okay? And if you study the charts, you will see that this is what happens most of the times. So the question at this point would be, how can I incorporate this into an actual trading strategy? Well, a trading strategy is not only technical rules, right? All the concepts that you have to incorporate into a trading strategy are the technical rules, which at this point would simply be wait for a support to be created or resistance to be created, wait for the fake breakout, wait for the retest after the close back above or below the zone. And at that point, you will need entry rules because you have directional rules and you have entry rules into a trading strategy. And then you also have risk management rules. Now, how you put all of that together depends from strategy to strategy. In this case, for example, if I can give some suggestions, is go down on lower time frames to pinpoint your entry, okay? For the direction, you have the support, you wait for the fake breakout, you wait for the move back above, you wait for the retest. But when you have the retest here, I would suggest to move down on lower time frames, like for example, the 4 hour or 1 hour, for wait for proper confirmations. Now, which are those confirmations? That depends from you, from your trading style, from your trading personality, and what you actually like to see. Maybe you like to see some specific candlestick formations. Maybe you just like to rely on indicators, or you like to just trade with pending orders and just have a buy limit on the retest of the support with your stop below the low of the manipulation or something like that. One important thing that I can say is that most of the times you will not see, in my experience, I noticed that you will not see the market go back below the low of the manipulation, which makes a lot of sense because if institutions entered around this area, they don't want to bring price back below to their entry. They just want to drive the price above to profit, obviously. So they will manipulate here, enter here, and then just have buy stops all across the zone to just keep pushing the price to the upside and keep bringing profit to their original order, okay? So putting your stop loss below the low of the manipulation could, for example, be a good suggestion because in my experience, most of the times, you will not see the price drop once again below that zone, which could be an interesting trick. But overall, how you're supposed to be building a strategy around this, as usual. First, you have to backtest the strategy. You have to find the rules, adjust the rules to your own trading style and trading personality. Have a trading plan for that specific strategy, both from a directional and entry perspective with specific conditions. You have to prove it in backtesting that it actually works. Also, then after that, you have to demo trade to see that you can actually replicate that in actual real-time markets. And then after these two steps have been created and accomplished, basically, what you can do at that point is you can start testing out on an actual live account your new strategy. And this is basically, in my opinion, the best way to approach fake breakouts and actually use them to your advantage.
Now, if you don't know what I'm speaking about when I say shift of market environment and valid entries, that is all part of the mentorship program, which you can now access completely for free. The link is in the description and I really suggest that you go and check it out. Also, if you enjoyed the video, make sure that you smash that like and comment below. It really does support the creation of more free analysis education and updates for all of you because obviously it helps with the YouTube algorithm, and I will see you in my next video.